Every year, countless individuals are drawn to the stock market, lured by the promise of financial independence and quick fortunes. They arrive with capital and high hopes, yet statistics consistently show that the vast majority, 90% or more, will fail. They will lose their initial stake and depart, convinced that the market is an indecipherable game rigged against them. Why is this failure rate so astonishingly high? The reason is that most approach the market as a place for guesswork and gambling, not as a serious business venture. They act without preparation, without knowledge, and without a definite plan. William Delbert Gann, a man who dedicated over 45 years to the scientific study of markets, stood in stark opposition to this chaotic approach. He was not a mystical seer, but a master technician who developed a clear, business-oriented methodology designed to turn speculation into a profitable profession. He understood that for anyone starting from zero, success is not built on a single secret formula, but on a foundation of unbreakable, fundamental rules. These rules are not glamorous or exciting. They are the bedrock of discipline, risk management, and psychological control. This video will serve as a definitive guide to the 9 essential starter rules that William Delbert Gann insisted every new trader must follow. They are his blueprint for survival, the essential foundation upon which a successful trading career can be built. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most important of all the rules laid down by William Delbert Gann concerns the preservation of your primary business asset, your capital. He codified this into what can be called his cardinal law. Divide your capital into 10 equal parts and never risk more than 1/10 of your capital on any one trade. This is not a suggestion. It is the absolute, unbreachable first line of defense for any person who wishes to survive in the speculative markets. The new trader, eager for large profits, often views this rule as overly conservative, a hindrance to rapid growth. This is a fatal miscalculation. The 10% rule is not about limiting profits. It is about ensuring your ability to stay in the business long enough to find them. Let us analyze the mathematical certainty behind this rule. Suppose a trader starts with a capital of $5,000. Following the rule, his maximum risk on any single trade is $500. If he buys a stock at $50 per share, this rule dictates that he cannot trade more than 100 shares with a 5-point stop-loss order or 50 shares with a 10-point stop-loss order. His total exposure is strictly defined before he ever enters the market. Now consider the inevitable reality of trading. You will have losses. Even the most seasoned professionals have periods of drawdown. Imagine this trader is wrong on his first trade and loses $500. His capital is now $4,500. For his next trade, his maximum risk is now 10% of his new capital, or $450. This automatic mathematical adjustment forces a reduction in trading size after a loss, preventing the trader from doubling down in a desperate attempt to win his money back. The psychological stability this provides is immeasurable. The trader who risks 50% or 100% of his capital on a single trade is no longer a speculator. He is a gambler playing a single hand of cards. The mental pressure of such a position is immense, making rational decision-making impossible. Every minor fluctuation against him becomes a source of extreme anxiety. He is ruled by fear. The trader following the 10% rule, however, operates from a position of psychological strength. A single loss, while not desirable, is never catastrophic. It is merely a calculated business expense, a small tuition fee paid to the market for a lesson learned. He knows that he can be wrong 9 consecutive times and still have a significant portion of his capital intact, ready to be deployed on the 10th trade, which may be the beginning of a major profitable campaign. This rule transforms trading from a nerve-wracking gamble into a calm, methodical business of risk management. It is the absolute law of survival. The second rule is the practical execution of the first. It is the mechanism that turns the theory of capital management into a real-world automated safeguard. The rule is simple and non-negotiable. Always protect a trade with a stop-loss order. William Delbert Gann considered the failure to place a stop-loss order to be one of the worst mistakes a trader can make. A stop-loss order is an order given to your broker to close your position at a predetermined price if the market moves against you. It is your unconditional insurance policy, your emergency exit, your guarantee that a small, manageable mistake will never be allowed to escalate into a devastating financial blow. The new trader must understand what a stop-loss order is and, more importantly, what it is not. It is not a prediction of where the market will stop. It is a declaration of the maximum amount of capital you are willing to risk to find out if your judgment is correct. When you make a trade, you can be wrong. The stop-loss order is your acceptance of this fact. You place it at the time you make the trade, not later when hope and fear have clouded your judgment. You determine your exit point based on a logical violation of your setup, for instance, 1 to 3 points below a confirmed support level or the bottom of a key swing chart formation. Once that order is placed, it must never be canceled or moved further away from the market. To do so is to replace a business rule with a hopeful wish, and as William Delbert Gann repeatedly warned, hope has no place in a professional operation. Many new traders resist this essential rule, often falling prey to the fear of being stopped out just before the market turns in their favor. They will recount a story where their stop was triggered at the exact low of the day, only to see the stock rally without them. William Delbert Gann acknowledged this possibility but framed it with professional logic. He knew that 1 time out of 10, a stop might be caught at a precise turning point. However, the trader who fixates on this one instance forgets the 9 other times that the stop-loss order performed its duty perfectly, saving him from a large and potentially ruinous loss by getting him out of a trade that was fundamentally wrong. The purpose of the stop-loss order is not to create a perfect exit. Its purpose is to enforce discipline and protect capital. It is the ultimate safeguard that allows you to correct your mistakes quickly and live to trade another day. If you do not know where to place a stop-loss order, you are not ready to make the trade. The third rule is a direct consequence of the first two, a behavior that William Delbert Gann labeled the greatest evil a trader can commit: never overtrade. Overtrading is the act of buying or selling more than your capital rule allows. It is the most common and seductive temptation for the new trader who is starting from zero and is desperate to make rapid progress. After a few successful trades, a feeling of overconfidence sets in. He begins to believe he has mastered the game and abandons the strict 10% rule in favor of larger positions, hoping to accelerate his profits. This is the beginning of the end. Overtrading is a violation of financial science. It breaks the mathematical foundation of risk management that is designed for long-term survival. A trader with $5,000 who correctly risks $500 per trade can withstand several consecutive losses. A trader with the same capital who decides to risk $2,500 on a single trade is only 2 mistakes away from being completely wiped out. This creates a state of extreme psychological fragility. When a large portion of one's capital is at risk, every decision becomes emotionally charged. The trader watches the tape with a knot in his stomach, his judgment clouded by an all-consuming fear of loss. Furthermore, overtrading leads to mental and physical exhaustion. The trader who is in and out of the market constantly trying to scalp small profits is subjecting himself to relentless stress. William Delbert Gann noted that this constant activity leads to warped judgment. The trader loses his sense of proportion, becomes unable to distinguish between minor, meaningless fluctuations and a genuine change in the primary trend. He acts too quickly, gets whipsawed by the market's noise, and drains his capital through a steady stream of commissions and small losses. The cure for this evil is to return to the foundational rules. Trade only when a definite, high-probability setup appears. Adhere strictly to your capital management rules. By doing so, you trade less, but you trade better. Your decisions are calm, reasoned, and based on your plan, not on the anxious impulse to always be doing something. True progress is not measured by the frequency of your trades, but by the steady, disciplined accumulation of capital over time. Of all the errors a new trader can make, the fourth rule from William Delbert Gann addresses what is perhaps the most insidious and financially devastating: never average a loss. This practice, often called averaging down, is a cardinal sin in the Gann methodology, and he considered it one of the worst mistakes a trader can make. To the novice, it can seem like a clever strategy. If you liked a stock at $50, you should love it at $45, and buying more seems like an opportunity to lower your average cost and increase your potential profit when the stock eventually turns around. This logic is a siren song that has led countless accounts to ruin. It is a decision born not of strategy, but of ego, and a stubborn refusal to admit a mistake. Let us dissect the destructive logic of averaging down. A trader makes a purchase based on a set of rules or an analysis that indicates the stock should advance. The market, however, moves against him. This is the first and most important piece of feedback the market can provide. His initial judgment was wrong at that time. The stock is not acting as it should. Instead of heeding this clear signal, the trader who averages down decides to argue with the tape. He tells himself that the market is temporarily mistaken and that his original thesis is still correct. By buying more at a lower price, he is not making a new, independent decision based on fresh evidence. He is willfully reinforcing his original error. He is, in effect, sending good money after bad, doubling down on a losing proposition. William Delbert Gann saw this clearly. If your first trade is going against you, why would you increase your risk and buy or sell more to average a loss? When things are getting worse, you should not do your best to make them worse. The professional approach is the polar opposite. When a trade moves against him and hits his predetermined stop-loss order, the professional trader accepts his mistake immediately and closes the position. He takes a small, manageable loss. This single action accomplishes two vital objectives. First, it preserves the bulk of his capital, ensuring he has the financial ability to trade again when a true opportunity arises. Second, and just as critically, it preserves his mental clarity. His mind is now free from the burden of a losing position. He can look at the market with an unbiased eye, ready to analyze the next setup objectively. The trader who averages a loss, however, becomes mentally and emotionally trapped. As his position grows larger and the loss deepens, his judgment becomes progressively more clouded. He is no longer analyzing the market, he is praying for it. Every minor tick in his favor brings a surge of false hope, and every decline brings a wave of sickening fear. He becomes financially and psychologically committed to this one trade being right. And he can no longer see the market as it is, but only as he needs it to be. This is a state from which sound decisions can never be made. The rule to never average a loss is therefore a rule of both financial and psychological preservation. It is the discipline of admitting when you are wrong, taking your loss quickly, and moving on with your capital and your clarity intact. The fifth fundamental rule provides the strategic compass that guides all of a new trader's decisions. Do not buck the trend. William Delbert Gann taught that the market is like a powerful river with a dominant current. The way to make money is not to fight this current, but to determine its direction and then follow it. He stated, "You must learn to go with the tide and not against it. Discern the signs of the times and do not get caught in the undertow when the tide is flowing out. The path of least resistance is the path of the trend, and the greatest profits are made by moving in harmony with the market's primary force. The new trader's primary task is not to become a hero who perfectly predicts the exact top or bottom of a market. This is a fool's errand that has destroyed many more experienced operators. The attempt to pick a top in a powerful bull market is to stand in front of a speeding train, hoping you can stop it. The market can and will remain in what seems like an overbought condition far longer than a trader's capital can survive. The same is true for trying to catch the falling knife by picking a bottom in a severe bear market. The professional trader, as instructed by William Delbert Gann, does not engage in these ego-driven guessing games. His first and most important job is to learn the scientific methods of identifying the established dominant trend. Once the trend is determined to be up, the strategy is clear. He waits for normal reactions and pullbacks to buy. He never sells short in a rising market, no matter how high it appears. Conversely, once the main trend is determined to be down, his strategy is equally clear. He waits for the natural rallies and bounces to sell short. He never attempts to buy the lows in a declining market. This approach keeps the trader on the right side of the market's momentum. It ensures that the primary force is working for his position, not against it. While he may not capture the first 10% of a new bull market or the first 10% of a new bear market, he will be positioned to profit from the large middle section of the move where the trend is clear and the momentum is strongest. Trading with the trend is a cornerstone of conservative professional speculation. It is a rule that replaces the desire to be a perfect market timer with the much more profitable goal of being a disciplined trend follower. The sixth rule for a new trader is a vital command for preserving mental capital and ensuring that decisions are only made from a state of clarity and confidence. When in doubt, get out, and don't get in when in doubt. Profitable trading requires a clear mind, free from confusion, hesitation, and emotional turmoil. Doubt is a signal from within that something is wrong. It may be that the market's action has become chaotic and unpredictable, or it may be that the trader himself has lost his analytical edge. In either case, doubt is a warning sign that must be heeded immediately. To hold a position while in a state of doubt is to subject your capital to the whims of a compromised mind. A trader who is uncertain about his position will be easily shaken out by a minor, meaningless fluctuation. He will be paralyzed by fear when he should be taking a small loss, and he will be indecisive when he should be adding to a profitable trade. His judgment, as William Delbert Gann noted, gets worse the longer he holds on and hopes for the market to go his way. The only correct action when you find yourself in a state of confusion is to close all your positions immediately. Many new traders find this rule difficult because they feel a compulsive need to always have a position in the market. They believe that being on the sidelines means they are missing out. William Delbert Gann taught the exact opposite. He understood that being in cash is a safe and powerful strategic position. When you are out of the market, you can observe its action with a calm and impartial viewpoint. Your judgment is not clouded by the hope that a current position will move in your favor, or the fear that it will go against you. You can analyze your charts, review your rules, and wait patiently until the market provides a setup that is so clear and definite that it removes all doubt and replaces it with confidence. Only then should you consider risking your capital again. This rule is a mandate for clarity. It teaches the new trader that his mental state is just as important as his technical analysis, and that preserving his peace of mind is essential for long-term success. The seventh rule from William Delbert Gann addresses a critical strategic decision that every new trader must make: where to focus his limited capital and attention. The rule is practical and direct. Trade only in active leading stocks. The market is a vast ocean of hundreds, even thousands, of securities. The novice, seeing a stock priced at only a few dollars per share, is often tempted by the idea of buying a large number of shares for a small amount of money. He believes these cheap stocks offer the greatest potential for profit. This, William Delbert Gann taught, is a fundamental and costly error. Low-priced stocks are almost always low for a very good reason, and they often become dead money, tying up a trader's capital for months or even years without any significant movement. The professional trader understands that profits in the market are generated not from low prices but from fluctuations. He seeks movement and activity, for it is in the wide swings of a stock that the greatest opportunities reside. Active leading stocks, typically those with strong institutional interest and high daily volume, provide three essential advantages. The first is liquidity. An active stock always has a ready market, meaning a trader can buy or sell his desired quantity at any time without significantly impacting the price. In a slow, inactive stock, the spread between the bid and ask price can be enormous, and trying to sell in a hurry can mean accepting a price far lower than the last quote. Liquidity ensures a clean, efficient entry, and more importantly, a reliable exit. The second advantage is opportunity. Active stocks move. They have wide daily and weekly ranges, providing numerous opportunities to make profits on the swings. If a trade in an active stock goes wrong and results in a small loss, the trader knows that another opportunity to recoup that loss and turn a profit will likely present itself soon. Capital tied up in a dead, inactive stock is capital that is not working. It is frozen, unable to be deployed when a real, high-probability setup appears in a market leader. The third advantage is the reliability of price action. The movements of major leading stocks are a clearer reflection of the broad economic forces of supply and demand. Their charts are cleaner, their trends are more defined, and the signals of accumulation and distribution are more pronounced because the composite man, or the sum of all professional interests, is most active in these issues. The price action of obscure, low-volume stocks is often erratic and meaningless, subject to the whims of a few small players. By focusing on the active leaders, the new trader is placing himself in the main arena where the real game is played, ensuring that the principles of trend and volume analysis can be applied with the greatest degree of confidence. The temptation to buy cats and dogs simply because they are cheap must be replaced with the professional discipline of trading only where the real opportunities for fluctuation and profit exist. The eighth rule is an essential principle of trade management, designed to combat one of the most painful and demoralizing experiences a trader can have. The rule is, never let a profit run into a loss. William Delbert Gann stated that more traders are ruined by violating this rule than almost any other, save for overtrading. It addresses the destructive combination of greed and indecisiveness that plagues the human mind once a trade becomes profitable. A trader enters a position, and the market moves in his favor. He has a profit of 3, 4, or 5 points. At this moment, his primary objective must shift from seeking further profit to, first and foremost, protecting the profit he has already secured. The practical application of this rule is the mechanical adjustment of the stop-loss order. Once a trade shows a reasonable profit, William Delbert Gann suggested 3 to 5 points on an average stock. The initial stop-loss order, which was placed below the entry price to protect capital, should be moved up to the break-even point, or the original entry price. This single, simple action is transformative. It instantly removes all risk of capital loss from the trade. The position is now a free trade. The worst possible outcome is no longer a loss, but simply the lack of a gain. This liberates the trader from the fear of giving back his profits and allows him to hold the position with greater confidence, letting it run as long as the main trend continues in his favor. The trader who fails to follow this rule is often, as William Delbert Gann described him, hoggish. He sees a profit and immediately wants more. He refuses to protect his gain because he fears a minor reaction will stop him out and prevent him from capturing a much larger move. He holds on through the first pullback, watching his paper profit shrink. When the stock fails to make a new high and begins to decline again, his greed turns to hope. Hope that the market will just rally one more time to let him get out with his original profit. He holds on as the stock crosses his entry price, and his profit officially turns into a loss. Now, the destructive psychology of hope, which we have already discussed, takes full control, and a once profitable trade often becomes a significant and completely unnecessary loss. The professional trader avoids this painful scenario through pure mechanical discipline. Protecting a profit is not a matter of judgment or market timing. It is an automatic, non-negotiable rule. It is the art of ensuring that a correct decision is never, through inaction or greed, allowed to become a losing proposition. We now arrive at the ninth and final starter rule, which is, in reality, the great principle that encompasses all others. It is the foundation upon which a professional trading career must be built, the single most important factor that separates the consistent winner from the chronic loser. The rule is this: trade on knowledge, not on hope. William Delbert Gann stated that the single greatest cause of loss in the markets could be traced to one source: a lack of knowledge. The average person enters the market without any preparation whatsoever. He would not attempt to perform surgery or build a bridge without years of dedicated study. Yet he will risk thousands of dollars in the complex and competitive arena of the stock market based on nothing more than a tip from a friend, a newspaper headline, or a vague feeling of hope. This is the path of the gambler, and it always leads to ruin. To trade on knowledge is to treat speculation as a profession. It requires a period of intense study and preparation before a single dollar is ever risked. It means putting in the time and effort to learn the definite time-tested rules that govern market action. It means doing the work of compiling and studying historical charts to understand how markets have behaved in the past, knowing that human nature does not change and history will repeat. It means coming to the market each day with a well-defined plan, knowing exactly what setup you are looking for, where you will enter, and where you will place your protective stop-loss order. When you trade based on knowledge and a definite plan, the emotions of hope and fear become irrelevant. You do not hope a trade will work. You have a set of rule-based reasons that give you a high probability of success. You do not fear a loss. You have a stop-loss order that has mathematically defined and limited your risk. Your actions are not emotional reactions. They are the calm, deliberate execution of a predetermined business strategy. This is the ultimate goal of the professional trader. All of the preceding 8 rules, managing capital, using stops, avoiding overtrading and averaging losses, following the trend, getting out on doubt, trading active stocks, and protecting profits, are the mechanical expressions of this final great principle. They are the tools that allow a trader to operate on the basis of facts and rules, not on the destructive impulses of human emotion. In conclusion, these 9 rules laid down by William Delbert Gann are not a random collection of trading tips. They are a single, interconnected, and comprehensive system for building a trading career from the ground up. They are a blueprint for survival and a foundation for success. The rules of capital management and stop-loss orders are your shield, protecting you from catastrophic loss. The rules against overtrading and averaging losses are your discipline, preventing you from reinforcing your own mistakes. The rules of following the trend and getting out on doubt are your strategic compass, keeping you aligned with the market's force and ensuring your decisions are made with clarity. The rules of trading active stocks and protecting profits are your business plan, focusing your efforts on opportunity and ensuring you keep the money you make. And finally, the overarching rule to trade on knowledge, not hope, is your professional creed, elevating your practice from a gamble to a science. These are the fundamental laws for anyone who is starting from zero and wishes to follow the path of William Delbert Gann in making speculation a truly profitable profession.